Today we're going to take a look at some data from Hedge about sales in the cannabis industry. That's total sales from about 14 different markets in North America. We're going to look at year-over-year sales growth, which is negative in a lot of cases. The average basket, meaning the average amount that people are spending, also decreasing, but the number of times they're going to the store increasing. Brand concentration kind of remaining the same, but there's a little bit of an uptick as some companies are capitulating. We're going to talk about all of that coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business podcast. So as we mentioned pretty much every month that we saw a decline starting in August of 2021 last year. And after that, pretty much every month has been a decline with the exception of December. December had a Christmas boost, probably supported by your in-laws and New Year's Eve. With the exception of December, there's been 6 months of consistent declines since May of last year in a lot of these markets. California had 420 million in sales last month. They're down to 402. So we're seeing that consistently come down. If you look at last year, they only had 394. So it peaked again around May, but we didn't see substantial declines until at least after August. However, it's across the board. It's across the board from North America. Every single province in Canada, every single product category, everything is decreasing in price. And I don't believe the common narrative, which is that, oh, the pandemic's over and people are going back to work and that everyone who was stuck at home was consuming more and now they're consuming less. I don't buy that. I look at it and see, okay, my brother-in-law had to quit because he can't afford cannabis because of gas prices, because of the cost of food, because of inflation. So this is a much larger issue, in my opinion, than just the end of the pandemic and people going back to normal and consuming less. I don't buy that. I think this is a lot. There's a lot more to the story, I think. So as you can see, whether it's Colorado, if you look at the older established states, doesn't matter. The majority of all of these markets are continuing to decrease. So Saskatchewan and Ontario, Alberta, British Columbia, all decreasing. When we look at the sales growth, those numbers are pretty bad as well. You see some positive figures in new markets, Michigan and Ontario and Arizona, but they're a fraction of what they were before. You look at Michigan at 195 last year, Ontario 158, British Columbia at 93, even Washington State at 20. That was last year. Now Washington State's -7, and you're seeing Maryland at 3 or -4 actually this month. Massachusetts at 36, Michigan at 39, Ontario at 60. So it's a fraction of what they were at last year. And I think that's kind of the point. Arizona, January was 101. Now they're at 14%. So I don't know if that was a Christmas hangover and everyone is going out buying stuff, but they're definitely not doing it now. 14% in Arizona. I don't have a lot of data from last year, but I do see 97 to 103% November, December, and then January 100%. And bam, February hit and you've got half as much. March hit and then you've got nothing, just 14%. So this is a substantial change in the growth rate for the industry, and I think it has everything to do with the price pressures of inflation and common goods and services. All right, so let's take a look at the average basket, how much people are going in and buying. If we start with California, they had an average $65 last year, and that's because of the delivery price being 65. So it was roughly between $65 and $70, and then has dipped significantly since spring of last year, and then now we're below $60. So that's a clear indicator, and I've been saying this for a while, that people are going into the stores, spending less, driving that average price down, and it's going across the board. Even in convenient places like Washington and Oregon, they're spending less on average. So they're going in, spending less, but as you'll see in a moment, they're going in more often. So California had 6.8 million transactions last year. If you were to look, some of the amounts as low as like 5.8 million. So there's definitely an increasing amount of people going into the stores, which is inversely related to how much they're spending. They're going in more, spending less. So even in Washington, 3.1 to 3.3 million times, but again, spending less. This dollar amount is coming down, and the amount of times that they're going up relative to last year. So, it's pretty steady in Washington, Oregon, all about convenience, and prices are really cheap in Oregon. You can get an ounce for $19 or whatever. But across the board, prices are decreasing on the East Coast, decreasing in Canada, decreasing in the existing marketplace on the West Coast, and the amount of times they're going in is increasing. For the most part, I mean, we're starting to see a little bit of a dip, and maybe that's going to be changing as people go less often. Arizona, 500,000 less this last month than January. Same with Illinois, 250,000 people less, 100,000 less in Massachusetts and Maryland and Michigan and Ontario. It's dipping. So I think maybe people have gone in as much as they're going to, but I don't believe that the price is stable yet. I think we're going to see a dip in the pricing still. And I think the amount of times they're going to go in is going to drop also. What does that mean for companies that are still in business? Is that an opportunity? Are they going to have a better chance of merging, expanding, taking market share away from other people? This is the part of brand concentrations. This is calculated by looking at the top 10 brands and how much market share they have collectively. Places like Washington and Oregon, it's approximately 1/5 of the entire market is owned by just 10 companies, 22% Washington and Oregon. California is closer to 28. Colorado's at 1/3. Places like Pennsylvania were even worse. It was something like 80% market share because it's a very limited license state and medical only, and just not a lot of competition. So top 10 stores in Pennsylvania, at least last year, had approximately 80% of that market share. It's around 75 to 85%. So it could be worse, I guess. But in the meantime, I think there's still opportunities for companies to merge, especially with the economy looking like it's going to end the longest bull market in history and come to a major, massive correction, which a lot of people aren't ready for. Not ready for it at all. Couple that with the inflation and the price pressures with that, I think a lot of people will probably take that opportunity to get out of the game, sell, liquidate, or just close shop as things get worse. So we'll take a look. Obviously, we'll be doing this monthly and take a look at some of the stats on total sales and sales growth and where the market's going. You just have to come back to the Talking Head and find out.
With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.
Don't forget to smash that like button on your way out and check out these other videos that we've got.